In this video, I'm going to explain when you should probably consider operating your business as a C corporation. And to give you a preview of what I'm going to cover, let me explain what some of these topics are. Taxes, right? That's when you want to know, can a C corporation save you money in taxes? Don't worry, I'll got you covered and I'll explain a unique situation where it actually might. Non-taxable fringe benefits. I'll explain what these are and when C Corps may be better as it relates to fringe benefits when compared to other tax structures. Distributions, or what you might call dividends. Are there differences between taking money out of your business when you're taxed as an S corporation or a C corporation? Yep, you bet there are, and I'm going to explain them. And the remaining topics will be what happens when the owners of a business die. Does the business live on? Which entity is best for raising capital from many investors? And also, which entity supports having non-resident aliens as shareholders? But before we dive into the tax part of this video, let me just quickly introduce myself if it's your first time watching. My name is Navi. I'm a CPA and tax strategist that produces content for free right here on social media, but I also do it through a course. The course is designed to transform business owners from a state of not knowing much about running a business into tax-savvy entrepreneurs who finally understand business taxes, bookkeeping, and how to implement powerful tax strategies that will save them thousands of dollars in taxes. If you're interested in learning more about the course, you can click on the link in the description below or visit my website, which is navimuradcpa.com. Okay, let's dive into this first topic of C Corp taxes. I want to show you a unique situation where it may make sense to have your business taxed as a C corporation instead of the most common tax structure, the S corporation. And I'm sure there are many, but in general, the situation I see most often when the C Corp can make some sense is as follows. Here's the scenario. Your spouse is a high wage earner or perhaps has a very profitable small business, and as a result, regardless of how much money you earn in your small business, you're going to be paying federal taxes at the rate of either 32, 35, or even 37%. So saying that another way, I'm saying regardless of how much money you earn in your business, your spouse's income, because it's so high, is throwing you into a 32% or greater tax bracket. I typically see this when the spouse is maybe a physician or works in the tech industry or in the upper management of sort of a large publicly traded business or something like that, okay? So your spouse is a high wage earner. Let me show you this via an example that I've kind of got on my screen here, okay? Again, we're saying your spouse earns $400,000 at his or her day job. And in addition to your spouse's income, you've got a business that earns $200,000 in profit. Let's look at what your tax situation might be, whether your tax is an S corporation, a C corporation that takes dividends out of the C corporation, and a C corporation that defers the dividends that you can take. Don't worry if you don't understand what those dividends are. I'm going to explain those too, okay? So let's have a look here. I want to unpack this a little bit for you. So I've got 3 columns. Again, there's some similarities between all columns. So let me kind of quickly go through what's similar, and then we'll talk about the differences. So no matter which column we look at here, the same things are happening. Your business is earning $225,000 in revenue, has $25,000 in expenses. That could be advertising, marketing, things like that. And so your business profit is $200,000, right? Now, your reasonable compensation that you have to pay yourself, whether you're taxed in an S corporation or a C corporation, is $70,000. This is basically the amount of salary you're going to take from the business for the various sort of hats that you wear and functions that you provide to your S corporation, okay? The remaining money is going to come out whether it be a distribution as in an S corporation or a dividend with a C corporation. But either way, if you got 200 grand in profit and you pay yourself 70, what's remaining is $130,000. And then the last thing that's consistent across all 3 examples is the taxes that you pay as a employee of your S or C corporation, okay? So what is this? This is just saying that John, okay, in this situation, your name is John, on the $70,000 of wages, you're going to pay 6.2% in Social Security and Medicare taxes, and I believe 1.45% in Medicare taxes, okay? So John is paying a total of 7.65%, which 6.2 is Social Security and 1.45 is Medicare, okay? Now, John's S corporation, right? Your S corporation is also going to pay these taxes, but as an employer. Here you're paying it as an employee. here you're paying it as an employer. But if this is a small company, it's your money, right? It's coming out of your pocket. It's just coming out of the S corporation's pocket. So the total there you can see is $10,710. Again, that's across all three. Nothing changes there against all three of these examples. All right. But an S corporation is called a pass-through entity. What does that mean? That means that the profit, the $130,000, is going to pass through the S corporation and land on the owner of the S corporation's tax return. Okay? And so what we've got here is a situation where you and your spouse together are going to have to pay $135,174 in income tax. I know that number is huge because you're looking at it like, wait a second, I made 200 grand, I'm going to pay this much in tax. That's not what I'm saying. Let me unpack this just a little bit because it can confuse you if you're watching this video. What I'm saying here is your spouse earned $400,000 at his or her day job, okay? And I'm assuming here that they haven't paid any income taxes. In reality, income taxes would be withheld from his or her paycheck as they're earning their money, right? But I'm saying in this situation, for you to understand fully how much income tax is actually being paid, it's $135,174. This is the amount of money that you have to pay based on your spouse earning 400 grand and your business earning 200 grand, paying $70,000 in salary and 130,000 as what would be called distributions, okay? So together, on roughly $600,000 of income, you're paying $135,174, okay? There's no federal capital gains tax to pay as an S Corp holder. State income tax, for this purpose, I'm saying you live in the state of Alabama, which has like a 5%, I believe, fixed tax. And so it's $21,874 in state income tax. So your total taxes, when you count Social Security and Medicare for yourself, federal income tax for you and your spouse, and state income tax for you and your spouse, it's $167,758 in taxes, okay? So again, you earn 600 grand, you're paying this amount in taxes. All right, let me now unpack the C corporation. And now you've got two C corporation columns, right? One where you receive a dividend and one where I'm saying you're going to defer receiving that dividend. Let me unpack that. What I'm saying here is this $130,000 of profit that the C Corp earned is going to have to pay taxes, income taxes, what's called C corporation income taxes. So right now, the C Corp tax rate is 21%. So 130,000 times 21% is $27,300. Your C corporation is not a pass-through entity or a flow-through entity. The C Corp itself is its own entity and has to pay $27,300 in income tax, okay? Now, let's kind of move further down. In this example, I'm saying that you paid yourself this $130,000, you took it out of the C corporation and issued yourself dividends, okay? So the dividends would be 130 grand. So how much federal income tax would you pay? Well, you're paying $104,320 in income tax, but you're also going to pay capital gains tax, right? So this $130,000, you're going to pay capital gains tax of $20,423. So federal capital gains tax, the way that works is depending on your income, combined with your spouse's income, you can either be in a 0% tax rate, 15%, or 20%. In this example, I think if I recall correctly, some of this is taxed at 15% and some of it's at 20%. And that's why the amount comes to $20,423. Your state income tax is $22,396. So your total taxes, and again, when I say total, I'm saying Social Security and Medicare, C corporation taxes, federal income tax, and the capital gains tax, and your state income tax is $185,149, okay? Hopefully that makes sense. Let's look at what you could do though. What you could do is instead of taking this $130,000 out and paying it to you as a dividend, you leave it in the C corporation. What this does, right, is avoids paying the capital gains taxes. It actually reduces your federal income tax a little bit too, okay? So there's reasons for that. I don't want to unpack them in this video, but I believe it's related to the net investment income tax, right? So federal income tax, $99,380, no capital gains because you didn't take that money out, right? You didn't take this 130 out. Your state income tax is $17,164. Again, why is it lower? It's because you didn't pay yourself this $130,000 in the form of a dividend. So your total taxes are $154,554. So you might be saying to yourself, okay, yeah, I'm definitely choosing this option because I can save myself roughly $12,000 in taxes when compared to the S corporation. But remember, you've got that $130,000 sitting in the C corporation. So eventually you're going to have to take that money out, right? And so when you do, you're going to have to pay capital gains tax on it and state income tax on it as well. So this is why you need to be careful. Don't just look at your year one situation and say, hey, I'm going to save $10,000 of taxes here. I'm going to go this route. That's not a great way to look at it. I should say that you're not going to save $10,000 when if you compare it to the other C corporation scenario, you're saving more like $30,000 in taxes, right? From here to here is a $30,000 tax savings. But if you had just been an S corporation to begin with, you're allowed to take out the 130 grand. Yes, you'll pay the tax on it, but the tax is only $167. So I think this makes more sense, right? The only way that this is going to make more sense by leaving the money in the C corporation is if you're kind of planning it ahead and you know that, okay, well, next year, here's what's going to happen. My spouse is going to stay at home for that full tax year. And I myself am going to have profits in my business that are going to decrease, okay? We're taking time off to, I don't know, take care of our kids or travel around the world, okay? And so in that year, the following year, you could just take this $130,000 out of the business, pay yourself a dividend only, okay? That might be a situation where it's quite unique, right? You're probably listening to this and be like, yeah, I'm never going to do that. But that's the situation where it might make sense. So if I were you, I would just be an S Corp and from day one and go that route. All right, I know that was a lot. Let's go on to our next benefit, which is these non-taxable fringe benefits, okay? Fringe benefits are benefits that you receive from your employer in addition to your wages. Some common examples include like health insurance or health reimbursement arrangements. Some of these fringe benefits may be taxable to you as the employee, meaning the fringe benefit being provided is a part of your taxable wages, and other fringe benefits are non-taxable. It's these non-taxable fringe benefits where the employer gets a tax deduction for providing the benefit and the employee receives the benefit tax-free, all right? A common non-taxable fringe benefit with small businesses is the health reimbursement arrangement, or HRA, and I mentioned that a moment ago. Your employer can pay for your healthcare costs, and you, the employee, don't have to pick that up as a benefit as taxable income to you, okay? This is an advantage of the C Corp structure that is typically not available or taxed differently if your business is structured as an S corporation. Let's talk about distributions, right? With an S corporation, distributions have to be taken proportionately, whereas with a C corporation, they do not. So recall my example where we said we had $130,000 in profit that we can take as a distribution if the business is taxed as an S corporation, or as a dividend if the business is taxed as a C corporation. Well, if there were two business owners that each own 50% of the business, then they would each need to take $65,000 out. You can't have one shareholder take a distribution of $30,000 and the other take out $100,000, okay? That's with the S Corp. With the C Corporation, because you can have different classes of stock, you can get creative in the way the shareholders receive dividends, okay? You can have one class of stock that pays dividends and one class of stock that does not. And there are, many other ways the stock can be structured that impacts the way the dividends are paid, okay? So you can have some flexibility there in the way you distribute money to the owners, okay? Let's talk about this next concept. It's called like perpetual existence, okay? What I mean by that is, as a general rule of thumb, C corporations don't die along with their owners, okay? The C corporation can live on indefinitely. Whereas if you've got, let's say you're a partner in a partnership and one of the partners dies, you no longer have a partnership, right? Now, if you do some proper planning, you can help avoid issues related to the death of a partner, but it's less complicated with a C corporation because that structure just lives on forever. Now, what about if you're going to be raising capital? And from many shareholders, right? More than 100. If you want to raise substantial amounts of capital from investors, the C corporation doesn't limit you to 100 shareholders like an S corporation does. So you can have thousands of shareholders, and some of those shareholders can also be businesses and not just individuals, something that's not available to you as an S corporation. So what I'm saying there is like the investors in your business can actually be businesses themselves, not individuals, right? You're limited with an S corporation that those investors, those shareholders, they need to be all individuals. Okay, what about if you plan on taking a company public, okay? If you plan on taking the company public, you can issue many different classes of stock. I won't go into the details here, but essentially the takeaway is that if you want to take the company public, your tax structure is usually going to be a C corporation. And the last kind of thing is the C corporation can have non-resident aliens as shareholders, while S corporations cannot. You cannot have non-resident aliens as owners of or shareholders of an S corporation. It's just not allowed. But what you can do with a C corporation is have owners or shareholders that are non-resident aliens. Okay, so in this video, I taught you when you might want to consider using a C corporation over another tax classification like the S corporation. In most of my other videos, I'm teaching you about tax strategies that can save you thousands of dollars in taxes. So be sure to subscribe. If you would like to learn more about business taxes in general, like LLCs, S corporations, C corporations, partnerships, and how they're taxed, I highly recommend watching this video. Is it long? Yep, this is one of my longer videos, but it's probably the most comprehensive and most thought out video I've ever made. And of course, if you really want to turn yourself into a tax-savvy entrepreneur who learns and implements tax strategies that will save you thousands of dollars in taxes each year, not just 1 year, but every year, you can click on the link below or visit my website, navimuradcpa.com, to enroll in my course. I'll see you in the next video.